In today's video, I'm going to break down why high interest rates might mean the perfect time for you to buy a house. Hi, I'm Rebecca Tongsanoon, and I've been doing residential real estate investing for over 25 years as a side hustle while working a full-time job. And now I have my own multi-million-dollar real estate investment portfolio. So if you're like me, you can't avoid all these headlines that say, Feds increase the interest rates, another hike by the Feds on interest rates, mortgage interest rates highest they've ever been in 22 years. And you know what that's doing? That is scaring away people from wanting to buy a house. And here's a secret. It's not always just about the interest rates. It's about the math. You have to do the entire calculation with the math to see what is affordable to you. And so the other big secret is that there are going to be a lot less people on the market for a house because they're scared. They see the headline and they say, oh, it's not a good time. We're going to wait. Well, here's what you can do. You don't have to wait. You can do the math, which I will show you if you stay until the end, and you can decide what you can afford with the interest rate where it is and get in there with no competition and buy a house. So what does this mean? There is less demand for houses, which means you probably don't have to get into a bidding war on a house. And when you find a house that you like, you are in a great negotiating position. So let's talk about 5 advantages on buying a house in a high interest rate market. 1, there is a lot less competition. So you're gonna arrive at a house to tour it, and it is unlikely that there are already 5 or 10 bids on there, some of them with all cash, where it's just impossible to make a good decision on a house because everything is emotional bidding at that point. So at this time, you can find a house, take your time, work the numbers, look around, do the inspections, and you're in a pretty good negotiating position because a lot of these houses have been on the market for a long time and there's just not as much demand. In terms of supply, life happens, so people always have to sell houses. So there will always be houses on the market that you can look at. 2, there is a potential that interest rates could go down. It's the highest it's been in 22 years. It might go back up, but at some point it may come down. And when it starts coming down, you could have a lower interest rate because of either the mortgage package that you selected or because you decide to refinance. So just because you are in a high interest mortgage and you close with a high interest mortgage doesn't mean that for the lifetime of you owning the house that you have to carry that mortgage rate. 3, so let's not forget that real estate is about building equity over time. So the sooner that stopwatch starts, the sooner you start building equity and wealth. So don't let those interest rates scare you. Make sure you do the math and check on the math. And if the math works, start that clock. 4, tax deductions. I am not a CPA, so I'm not going to tell you all the details about tax deductions, but buying a property might mean, depending on where you live and your financial situation, that you can actually take some tax deductions that will overall reduce your tax liability. And 5, if you're renting right now, your rent may go up and you don't have control over how much your rent goes up and you may have to move. In the case of a fixed rate mortgage, you know exactly how much you're gonna owe every single month and you can balance and budget for that amount and you protect yourself against any sort of rent increases. Okay, so you've stuck around, so let's do the math and see what you can afford. We're gonna work backwards instead of looking for the house that you would like to buy and working your way backwards from the sale price of the house to see what the monthly payments are. We're gonna start with the monthly payments. Here we go. Here's how we are gonna do some quick math. So first we go to google.com, we go to mortgage calculator and we search on that. Google has its own mortgage calculator, which is very convenient. So you want to click on monthly payments and you want to include taxes and fees. So make sure that is turned on. Okay. So at this point, we go to bankrate.com and we look for a 30-year fixed. And so I could go on and on about why all these other ones are possibly a good choice. But right now, the most common one is a 30-year fixed. So let's choose that. And we're going to see today's mortgage rates. Okay. So let's go ahead and we're going to change this. I buy a lot of properties in O2. I really like that area. And then let's just, for ease of the math, we're going to do a $500,000 purchase price. Your credit score matters. So put something here that you think is actually true. The higher the credit score, the lower the interest rate because you are considered less risky to banks. 30-year fixed. And FHA, if you are first time buying a home, You might want to put yes. We can talk about this more later. Let me know in the comments if you want me to do a longer video. I just want to show you overall how to do something very quick. I like to look for 0 points. Again, I'll explain points in a later video if you would like. Let me know in the comments what you would like to know as far as details go. But here's something, I'm just going to pick this one, 7.625. Okay, so we're just going to go over here and we're going to replace this 7.625. There you go. And so taxes, I can show you also later how to do property taxes that are a little bit more accurate. In Texas, property taxes tend to be higher because we don't have state income taxes, insurance. And so it just gives you a monthly payment right now. Let me fix the home price to $500,000, $100,000 down payment. Okay. So I roughly know that I need $3,500 if I am buying a home to live in. That is about $500,000 in Texas with the interest rates where they are today. And so that can let me know whether this is a value that is good or if I need to go lower or if I can afford more. You've done the math. You know about what your payment is going to be for a 30-year fixed mortgage rate. The next step is to start talking to mortgage lenders and banks to see what sort of other packages they offer and what sort of mortgage products they offer. How long are fixed year terms? Could you get a variable term? Do you think you're going to be in that house for maybe less than 10 years and you could sell it by then? Or maybe you're going to be able to refinance before a mortgage rate starts becoming variable. These are all options that you can consider by having your mortgage lender run these numbers. And you know what's great in a high interest rate market is that these mortgage lenders are not very busy. So they'll be more than happy to spend time with you to run all these different numbers and scenarios to see what will work for you best. And then finally, you know about the price of home that you can afford and what you should budget for. So when you start looking, now you can look within the range that you're comfortable and run those numbers, rerun those again, and make sure that whatever you do, you know the math and that you understand what your affordability is per month. So what are you waiting for? You know how to do the math. You know how to figure out what sort of mortgage package might be suitable for you. So go out there, do the math, work with your lender, and find a house and start your real estate journey today. Do me a favor, please subscribe, like, and comment below on other topics you would like to hear, and have a great day. See you later.